Welcome! A big thank you to the folks at Pro Tax Accountant for arranging this discussion. Today, we're breaking down a really crucial topic for anyone who owns a second property here in the UK, capital gains tax. More specifically, we're going to look at how the work you do on a property can have a massive impact on your final tax bill.
Okay, so let's just dive right in. You've sold a property. Fantastic. But then comes that big looming question, right? How much tax are you actually going to owe? And how can you make sure you're only paying what you absolutely have to? So first things first, let's get on the same page. What even is capital gains tax? Well, it's a tax on your profit, the gain you've made since you bought the place. It's not a tax on the total sale price, and believe me, understanding how that profit is calculated is absolutely key.
Now, this is why this all matters so much right now. For the 2025 to 26 tax year, the tax-free allowance has been slashed to just £3,000. Yep, £3,000. That's not a lot. It means that every single deduction you can possibly find is more important than ever before.
So, how do you actually figure out your taxable gain? Well, it all starts with a surprisingly simple formula.
It's pretty straightforward, right? Your sale price minus your purchase price plus something called allowable costs. And honestly, that last part, allowable costs, that's where the magic happens. This is where you, as the property owner, can actively and legally reduce your tax bill.
So what counts as an allowable cost? Well, you've got the usual suspects. Your estate agent fees, solicitor's fees, the stamp duty you paid. But the one we're really going to zero in on today, the one that's often misunderstood, is the cost of capital improvements.
Okay, this is the heart of the matter. We have to get this right, distinguishing a non-deductible repair from a tax-deductible improvement. Getting this right can literally save you thousands of pounds.
Let's look at it this way. A repair, that's just about bringing the property back to its original state. Think of it as normal upkeep. It is not deductible for capital gains tax. An improvement, on the other hand, genuinely enhances the property, it upgrades it, or adds something totally new. And that is deductible.
And here's some perfect examples. Fixing a leaky gutter or just repainting some walls, that's just maintenance. It's a repair. But adding an extension or ripping out an old kitchen and putting in a brand new one or converting a dusty old garage into a home office, now that's an improvement.
This table lays it out pretty clearly. You see, installing a central heating system where there wasn't one before, that's a huge improvement. But just replacing a broken fence panel with a similar one, that's just a repair. The key question is always, are you adding something new or just fixing what was already there?
Okay, enough with the theory. Let's see how this actually plays out in the real world to understand the direct financial impact of getting this right.
Let's talk about Sarah from Manchester. She sold a rental flat she'd owned for a while. Now, she bought it for £150,000, and over the years, she was smart. She spent £15,000 putting in a completely new bathroom and upgrading the entire heating system.
So look at how her calculation works out. She sold the place for £250,000. We take off the purchase price of £150,000. And then, and this is the crucial bit, we subtract her $15,000 in improvement costs. That brings her final taxable gain all the way down to £85,000. Now just think about that for a second. If she hadn't made that deduction, her taxable gain would have been £100,000. This simple act of classifying the work correctly and, critically, keeping the receipts made a really significant difference to her final tax bill.
So what's the big takeaway from all this? What's the most important action you can take away from this discussion? How do you actually put this into practice?
Honestly, it all comes down to meticulous record keeping. You have to keep every single invoice, every receipt. Take photos before and after major work. Seriously, those receipts are not just clutter in your drawer. They are potential tax savings just waiting to be claimed. And always, always remember this key point. The intent behind the work really matters. You need to ask yourself, was this just to patch something up, or was it to add real, lasting value for a future sale? Because that's exactly the question HMRC is going to be asking.
So we'll leave you with that final thought. Are your renovation receipts just a pile of clutter, or are they actually the key to lowering a future tax bill? It's something to consider the next time you're about to toss an invoice. Now, we know this can get complicated, and if you're feeling a bit unsure, it's always best to get professional advice. The team at Pro Tax Accountant are experts in this field. You can reach out to them directly. Their WhatsApp and phone number is 07985689912, or you can drop them an email at info@protaxaccountant.co.uk. They'll be able to guide you through the process.